See that solid line at the very bottom? That is minus C, or the friction constant. This is the most important number on the screen. It represents the literal cost of escaping to cash, the security, the transport, and the storage of physical bills. As long as the bank charges you less than this cost, you are stuck. The distance between zero and this line is the exit tax of the modern world.
They told you the zero lower bound was a floor. They were lying. Today we will show you why, then tell you how you should process and react. After today's incident response, you will transition from being passive observers to active analytical responder.
Just this past week, global markets held their breath as central banks signaled higher for longer to combat inflation. It's a sharp pivot from the era of negative rates we saw in Europe and Japan. For decades, experts claimed interest rates couldn't drop below zero. They argued no one would keep money in a bank if they had to pay for the privilege. They were wrong. In 2021, over 20% of global government bonds traded with negative yields. This wasn't a glitch, it was a calculated mechanic. Central banks realized you can't settle billion-dollar trades with suitcases of physical cash. You are trapped in a digital system. This convenience value of digital deposits allows banks to charge you for holding your money. Mathematically, as long as this convenience value exceeds the negative rate, the scam continues. It's not a floor, it's a trapdoor. Isn't it convenient that you literally cannot escape their digital ledger? Look at the dashed white line cutting across the center. That is a zero lower bound. For a century, that was the floor of the world. In a rational economy, interest rates shouldn't go below that line because you just hold cash instead. That is our sea level. Now watch the blue line, the demand for digital money. As it moves from left to right, it represents the modern banking system. Notice it doesn't bounce off the zero floor. It pierces it. This tells you that the value of being in the digital system is now higher than the value of holding physical paper. The curve isn't falling, it's being pulled into the basement. The shaded area is the digital vault. If the blue line is inside this glow, you are underwater. This is the convenience scam in action. You are paying a negative rate, essentially a storage fee, not because the market demands it, but because you are trapped by the sheer logistics of the digital ledger. You aren't a depositor anymore. You are a tenant paying rent on your own money. Notice how the blue line flattens out as it gets closer to that bottom limit. That's the calculation. The central banks know exactly how far they can push that rate into the negative before you'd finally snap and go back to physical cash. They are hugging the floor of your prison, keeping the rate just high enough that you stay conveniently trapped. Look at the quantitative easing QE heist, a masterpiece of financial deception. No one should believe the lie that this was for the people. Central banks printed massive reserves to buy domestic bonds. Isn't it strange that they expected banks to magically start lending to you? Instead, sovereign bond yields fell through the floor. Businesses didn't build factories or create new jobs with that cheap cash. They issued bonds to fund dividends and aggressive stock buybacks. Mathematically, asset prices were bid up while your spending ability was curtailed. It wasn't about growth, it was about inflating the wealth of those already holding the assets. This stimulus is a mechanic designed to reward debt, not productivity. Look at the left side of the screen. You see one line. But there are actually two lines, blue for assets and pink for wages, climbing together. You only see one line because for decades, your productivity and the stock market were the same thing. They were perfectly aligned. This is how a healthy economy is supposed to look. If a company gets more valuable, it's usually because it's producing more, hiring more, and paying more. The lines are in a social contract. The fact that they were once on top of each other is exactly what makes the current gap so devastating. It's a broken marriage. Right here at the decouple point, the central bank flips the switch on QE. When the QE rounds start, the blue glow behind the pink line is considered the shadow economy of debt. The blue line, assets, suddenly breaks upward exponentially, while the pink line, wages, continues a slow, agonizingly linear path. After QE, the blue line stops representing growth and starts representing liquidity. It's no longer fueled by productivity. It's fueled by the printing press. This isn't a curve, it's a vertical escape from reality. The area between the two lines is called the liquidity capture zone. This is the heist. Every dollar of stimulus that was supposed to help the economy was actually captured right here. Corporations used zero-interest loans not to build factories, the pink line, but to buy back their own stock, the blue line. The gap you see is the literal distance between the ownership class and the working class. By the end toward the right side, you see the vertical divergence. The blue line is in the stratosphere, while the pink line is stuck in the mud. To the talking heads on Wall Street, this graph looks like a bull market. But when you look at both axes, you see the truth. The market didn't grow. It just left the people behind. The wealth wasn't created, it was concentrated. Look at the yield curve, the ultimate crystal ball they use to gaslight the public. No one should believe it's just a neutral indicator of economic health. The mechanic is purely mathematical. The slope is driven by expectations of future short-term rates and a risk premium for volatility. In a normal expansion, it's upward sloping because you demand a premium for time. But isn't it interesting how it flattens when the central bank withdraws stimulus? They hike rates at the front end until the curve inverts, effectively signaling the very contraction they've engineered. This inversion isn't just a prediction, it's a confession that their policy is now restrictive enough to kill growth. They use these neutral rate estimates to justify squeezing you until the economy breaks. Look at the curve while it's blue. This is the natural order, the healthy smile. Short-term debt is cheap, and long-term debt carries a premium. It's an upward sloping line of confidence. But watch the left side, the central bank's territory. As the animation progresses, notice the long end of the curve. The 30-year bond stays relatively heavy. It can't rise because the market knows growth is dying. But the central bank is forcing the left side up. The line isn't just rising, it's rotating. It's like a seesaw where the bank is jumping on one end to catapult the economy off the other. The moment the curve turns pink, the crime is committed. This is inversion. The short-term rate is now higher than the long-term rate. Mathematically, the bank has made it more expensive to borrow for tomorrow than for 10 years from now. It is a total reversal of economic logic. When that tag recession kill switch appears, the confession is complete. By inverting the curve, the central bank has effectively made banking impossible. Why would a bank lend to a small business at 5% for 5 years if they have to pay 6% to borrow that money today? They won't. The inverted curve is the mechanical strangulation of credit. Now, let's look at the international linkage scam, where they export their debt and call it globalization. No one should think their domestic interest rates are an accident of local math. Isn't it obvious that in a world with mobile capital, your real rates are chained to everyone else's? The mechanic is simple. If a foreign country has higher real rates, your capital flees to them. This forces your currency to tank, which then imports their inflation directly into your grocery store. It's a race to the bottom that no one can win alone. Mathematically, the international Fisher effect claims these differentials should be offset by exchange rate shifts. But isn't it convenient how that theory fails during every major crisis? They use these global linkages to ensure that when one central bank sneezes, your entire savings account catches a cold. It's a global synchronization of misery where no one is allowed to escape the cycle. Watch the blue line, the world's reserve currency. It starts at the top, but it isn't staying there. It begins an aggressive unilateral dive. This is a policy of intentional devaluation. At first, the other nations, the EU, Japan, emerging markets, try to hold their ground. They want to protect their own math. But look at what happens when the lines meet, right there. The moment the blue line crosses through another nation's rate, it triggers a currency shock. Because the lead nation's rates are now lower, capital starts screaming out of the other countries and into the lead's assets. The flash you see is the market breaking. To save their own currency from a total meltdown, the other nations have no choice. They have to follow the leader into the basement. Notice the math after the crossing. The other lines don't just stay flat, they are hooked. Once the hegemon crosses you, your independent policy is dead. You are now being towed behind a ship that is heading straight for negative territory. By the end, the cross is complete. What started as 4 independent nations is now one synchronistic collapse. They've all crossed the zero line, they've all entered the vault. The international linkage isn't a safety net, it's the rope that ensures if the leader goes over the cliff, everyone else goes with them. This is the end of sovereign interest rates. Here is what I want you to do given all of these no BS angles. I want you to recognize that the zero lower bound is a myth designed to keep you trapped. In the past, it was assumed that nominal interest rates couldn't go below zero because people would just hold physical cash. It is crucial you understand that central banks have discovered the convenience value of digital money. Because it's hard to store millions in paper bills, they can force negative interest rate policies NERP on you, essentially charging you a fee to keep your own money in the banking system. You must accept that quantitative easing QE is a wealth transfer disguised as stimulus. When the policy rate hits zero, central banks move to large-scale asset purchases. I want you to see that while this is meant to lower long-term yields, you have to face the fact that the transmission mechanism often fails. When instead of business investment capex, this cheap liquidity frequently flows into asset price inflation, benefiting those who already own stocks and bonds, while doing little for the real economy. Internalize the reality that the yield curve is a crystal ball for your destruction. You cannot deny that the slope of the yield curve, the difference between short-term and long-term rates, is the ultimate signal. A steepening curve suggests the market expects the government to inflate its way out of debt. While an inverted yield curve, where short rates are higher than long rates, is a mathematical warning that a recession is imminent. Recognize that international linkages chain you to global failure. I want you to see that in a world of mobile capital, your local economy is not an island. Because global savings must equal global investment, I want you to see that a crisis in a foreign market will instantly transmit to yours via exchange rates and capital flows. It is vital to understand that the international Fisher effect suggests we are all mathematically linked to the same global cycle of misery. You have to realize that once you see terms like output gap, trend growth, and structural changes for what they really are, levers used to justify these interventions, you can no longer be a passive victim of the convenience scam. Finance is interesting, but only if you realize that the system is currently designed to harvest your future, to pay for their past.
Always keep in mind that finance is interesting because it is a series of deliberate trade-offs. The scam is simply when those trade-offs are hidden behind emergency labels and complex math. Remember, always look past the technical jargon to recognize the structural realities of the current economic environment.
This concludes today's incident response. See you in the next crisis.